take recording of that. So we're talking about capital budgeting, and most of you know what time value money is, so I don't need to regurgitate that. I just be aware there are three parts. The first part is the investment. The second part is the cash flow during the life of the project, and then you've got the final part is the wrapping up of the project. Just be a little careful for the taxation. Many countries have different tax treatments for how the initial investment is treated, especially if you're trading in old investment, and you've actually, it really depends on how much you've depreciated the previous investment, that tax authorities will allow you to have lots of benefit or no benefit at all. Okay, and the tax shield that you get during the life of the investment. Why? Because you can't claim it as an expense when you invest, so you claim it as a depreciation expense throughout the life of the investment, and then you've got the final salvage value adjustment. Okay, so you've got those three parts you need to keep in mind. All right, I don't want to force you to think about tax calculations, but just be aware, okay, even though we're not examining you directly on the tax adjustments. Okay, let's just turn this on again. All right, so how many of you know present value? Yes, you do. So if we discount 8%, how do you find that? You have a look in the tables, or you can do the calculation 1 over 1.08 to 1, 1 over 1.08 to 2, and so forth. So that's what 0.926 is 1 divided by 1.08, right? And then 0.857 is 1 divided by 1.08 square, and so forth. Okay, so you know where that all comes from. Here's another question. What about this 3.993? What is that? What does that mean? What's 3.993 mean? Hello? Quick. Time's running out. Quick. That's the annuity. Okay? You can actually do the adjustments 1 by 1 by 1 by 1 by 1, or you add them all up. They're all equal for 5 years in a row. 5 year in a row annuity at 8% discount is 3.993. How do you know that? You can go to the tables, you can see 8%, you can see 5 years, and it's on this side here, 8%, 5 years, and 3.993 there. Okay, so just, I know you know tables, but just reacquaint yourself with the tables so you don't get muddled in the exam, all right? Even if you know your calculator, at least know the tables too. Okay, now we want to look at the internal rate of return method. What are we talking about, the internal rate of return? We're just working at a present value adjustment, such that net present value is 0. Okay? So the decision point for net present value is, oh, let's choose if net present value is positive, and let's reject if it's negative. Or we choose the option that has the higher net present value. With internal rate of return, the discounted rate of return is the dependent variable. It's the final outcome of the analysis. Okay? So you've got these cash flows in the future. What does it take to discount these back to norm, back to today, so you get a 0 NPV? Okay? So there's a question about whether internal rate of return is better or equal to the required rate of return. Normally you accept the project if this happens. So you've got the calculator, we can do that. Present value discount 10%, that will bring it back down to 0. Okay, so when we had a required rate of return of 8%, if you go back to the 2 slides before that, the net present value was positive. Okay, move on. Any questions on that? Are there any questions on that? Right, these are examples straight out of the textbook, so I don't want to go too much detail, but just highlight different areas of the examples for you to circle and things like that. Okay. Some companies, they may want to calculate all the options, and one way of doing it is given a scenario analysis. What's this? A scenario analysis is, well, we don't know what the future rate of return is going to be, or the future required rate of return. Maybe it's a range between 6% and 10%. Maybe senior managers, they want some scenarios. What's the worst case scenario? What's the best case scenario? And not only in required rate of return, but in terms of annual cash flows. No one can predict the future with certainty, so therefore we have a range of future scenarios. And so that's what we mean by scenario analysis. All right, learning objective 4, you need to use and evaluate the payback method. So what's the payback method? It's the total amount of future cash flows divided by initial investment divided by the cash flows. And basically you're working out how many years does it take that we get our initial investment back in cash flow. So there's no discounting. Okay, so you're assuming required rate of return of what? 0? Okay, 0%. So you've got to realise, class, you've got to realise how old I am, okay? When I was going through, when I got fired from my first job, okay, it's a long time ago, 1979, okay, 1979, first job, I got fired, okay, and I was asked to leave my second job. Around that time, inflation was 17–18% per year. This is in Australia and the US, okay? So when we talk about capital budgeting and a discounted cash flow, that's very important. Time value of money is very important, okay? Most of your studies in the last 10 years have been in an economic context of there's no time value of money. Especially in Japan, it's negative. And in the US, it basically, you've got interest rates close to 0 for the last 5 years. Right? And so I can understand if you think, well, why do we care about the future so much and discounting it? We can borrow at next to 0% interest, you see? But it wasn't always like that. Okay? So, you know, economics changes from time to time. Maybe in 5 years' time, you know, the time value of money becomes much more important than it is today. Okay? So it's just a function of the context, a function of the society in. Ultimately, it's a function of the cost of your capital. And you've all studied corporate finance. Hands up again. All right? And the big thing that you learn in corporate finance is how to calculate the cost of capital, yes? Based on the structure of the I know, because I taught this course for 4 years, from 1992 to 1995 in Melbourne, Maibun, in Australia. Okay, so, and I've actually got recordings of my lectures, so if you want to listen to that, if you think I'm bad now, you should listen to it back then. Okay, I've improved. Okay, so we got the accounting rate of return method here. Accounting rate of return is not much different from payback. You don't care about time value of money. You've already got the information generated by the accounting system. So why not just do 1 or 2 more things and then we've got accounting rate of return. Okay? You don't have to make any assumptions about what we believe the future to be in terms of the required rate of return or internal rate of return. Look, just what's the return we're getting? When I talk to these suppliers in China, we ask them, you know, what is your gross profit? Now, if we ask them that, they don't tell us. So you've got to go indirectly in finding out. You know, I study your industry, and you know, some of the people we talk to, we get gross profit of up to 10%. Are you up around that mark, or are you higher or lower? And then you sort of go in there like that you get to find out. But if you ask straight away, what's your gross profit? They'll say, no, I'm not going to tell you that. No one tells you that. But what we find in some industries in China, the gross profit is as low as 3 or 4%, especially the PCB manufacturers. And so if they're investing in new machinery, the accounting rate of return, they may be happy if they could get a 5% return or 6% return. Then in other industries where the benchmark is 10 or 12%, then they're looking for a higher rate of return. Okay, so the benchmarks doesn't become time value of money adjusted. It's really a function of what the returns they expect in the industry that the company is in. So accounting rate of return is important. Why? Because you don't have to do much calculation. Okay, and so there's the formula there, and you can do that. All right. So here's the question from the exam 2 years ago. This is a question taken from the exam. Okay, so we have a crane, we have an investment. How much does it cost? The machine sells for $75,000. It requires working capital of $10,000. The useful life is 6 years, and it'll have a salvage value of $17,560. The recovery working capital will be $10,000. Normally, you'd take the salvage value of the initial investment divided by 6 to get your annual depreciation. Why do you do that? Because you multiply it by a tax rate to get your tax benefit. Okay? Depreciation is not a cash flow. The tax benefit associated with the depreciation is a cash flow. Okay? The recovery will be $10,000 end of the year. Annual cash savings from the purchase will be $20,000. Okay? Why do we say annual cash savings? Because maybe this company for the last 5 years, they've been, they need a crane, so then they've got to go and hire a crane when they need it. But now they're deciding, no, we want to buy it and own the crane. So if we buy and own, then we save that $20,000 renting investment we had to pay the last 5 years. You see? So that's what we mean by annual cash savings. All right, net present value, 12% required rate of return, compute internal rate of return, determine the payback period of investment, 3 marks. So here's the solution. We have the present value factor. You all know where that is. Do you know where the 4.11 comes from? Why do we have 4.11 here? Do you know why we have that? Again, do we have a regular saving every year that's exactly the same for a... So therefore we can use annuity. We don't have to do year by year by year by year by year. So you go to the annuity tables, which is on the other side of the page. And you've got annuity, and you've got 6 years, and you can actually find out how much over 6 years. So the 4.1 is the annuity. What are we working with? We're working with 12% required rate of return. So 4.111 is 12% annuity over 6 years. And then we have working capital return. So in year 6, that is the present value of money. And in year 6, that's the present value of money factor there. And then in the end, we have a present value that's positive. So therefore, we should go ahead and purchase the crane. What about the second part? If we do the internal rate of return, ultimately, with your calculator, you can actually work it out because you have an internal rate of return button. Is that right? How many of you have got a financial calculator? How many of you have got a scientific calculator? How many of you know if you're allowed to have both in the exam? You don't know, do you? My exam. You don't know. Do you want to ask the question? What's your question?
Are we allowed 2 different calculators that are allowed by the exam?
Yes, you're allowed to. Okay. All right. So you know what you're doing here? You press the IRR button and you actually work out the IRR. Okay. But when I was at college, we didn't do that or didn't have that function, so we had to do a trial and error. So we work out, net present value at 12%, it's above 0, so then let's try 16%, make it below 0, and then we sort of went in between, we found it. Okay? So You can start just above, just below, and see what happens, okay? Of course, you've got to go above. Why? Because at 12%, the net present value is positive, so therefore the IRR must be higher than the net present value, okay? I think you got that idea. All right, so what about, we're near the end, and learning objective 6. Identify and reduce conflicts from using discounted cash flow from capital budgeting decisions and accrual accounting performance evaluation. So that's for your home study. Have a look at one or two of the tutorial exercises that relate to that and see if you can answer those questions. It's very important. All right. Some managers are tempted to make capital budgeting decisions on the basis of short-term annual accounting results, even though it would not be in the best interest of the firm. Let me explain very clearly, that was not clearly explained in the textbook. Generally, if you're a manager and part of your bonus is dependent on how much profits that you make, then when you invest a huge amount in machinery, guess what happens? That depreciation makes those profits much lower, right? So sometimes managers are going to be reluctant to invest in machinery that they think is going to be beyond their own term in the organisation. Now, why would we think that when we're talking about, I said earlier that, you know, many firms don't care about the net 3 years beyond, okay? And HTC has product life cycle every 7 months. Like, things are so quick now. Why is this an issue? The average term of a CEO in the S&P 500 is around 3 years or less. Okay, there's a lot of turnover in CEOs. So my point is, you can't always count on CEOs to make big investment decisions for the long-term benefit of the organisation when, on average, most of them are not going to be around to benefit from the full use of the machine's life. Are you with me? This is heavy stuff here. Stay with me. So, is there a way, I can see some people asleep at the back, that's fine. It's my monotone voice, okay, that came from when I grew up in Australia. In the country, we used to pick grapes and send them to the winery. So when you drink the wine, you think about me picking the grape, okay? Now, getting back to here, how do you get CEOs? Seriously, I used to pick grapes. I could pick 200 buckets in a day, okay? There's a photo of me. I'll show you if you want to see it later. So, seriously, how do you get CEOs to think long term? Beyond the next 2 or 3 years, you know what I mean? Like, if you're going to invest $10 million in a new machine, which is something like what Apple will do with its suppliers in China, and then they'll say to the supplier, well, okay, we put the machine in your premises, but we own the rights to use its capacity, say 40% for the next 3 years, and then you can keep the machine for yourself. These are big investments, okay? Even more in many instances. How do you get CEOs to make these big choices when, personally, on average, they're not going to be around in 2 or 3 years' time to benefit from the machine? You invest in a machine, guess what? Suddenly, their profits go down. Why? Depreciation. Suddenly, their bonus goes down. So where's the incentive? There's no incentive. Okay? So I want you to think about it, and this is more, I want you to think deeply about this. How do you get them to do, how would you change the depreciation rules that would make them to think beyond their own term in the organisation? How would you change the depreciation? So you use straight line. I'll give you an example. So, $10 million machine, yes? Okay? All right, we want to depreciate it over 10 years. Okay? So, 1 million a year, right? 1, 2, 3, 4, up to 10, right? So we've got 1, 1, 1, 1. All right, so there's our depreciation. Now, that expense comes off the profit of the CEO each year, yes? So, when they invest in that 10 million, you've got a huge expense that is like that each year. Now, the CEO is only going to be around for maybe 2 years or 3 years at the most. All right? The cash flow from the machine might go up over that time. The benefits, the CEO is not going to benefit because they're at this stage of thinking about their own horizon. And so they're maybe more reluctant to invest in machines that go beyond the life cycle of the next 4, 5 years. Maybe they should be investing in machines that go for 10 years or longer. But they won't do that because on average they're not going to be around to get the benefits. So is there a way of changing depreciation to change that incentive? Let me make it, I'll give you a multiple choice, okay? There are 3 types of depreciation you can use. You tell me which one do you think would be most congruent with what the company's benefit would be, okay? Here are the 3 choices. You could have straight line depreciation like this. You can have reducing balance, which is, oh, we get a lot of depreciation in the first year. A little bit. So therefore, in the first 3 years, you've depreciated nearly 45 or 50% of the machine, right? Not so good for the CEO's bonus, right? Because depreciation is the expense, the bonus goes right down, huh? All right, and then in the later years, all right, it's very small, right? Or we could have increasing balance depreciation, that is, we have small amounts. All right, see that? So, A, B, or C. Which of these do you think would give the most incentive to CEOs to think in the long-term interests of the company? So, hands up for A, straight line depreciation. Remember, before you answer this, we're talking about CEOs making a decision that they don't care about what happens after year 3. They don't care about that. Okay? So if they don't care about that, they're going to invest in machines that just have a life of 3 or 4 years. Why? Because they get the benefits really, really fast. They don't want to commit to big machines that go out for 10 years. So which depreciation arrangement is going to help the CEOs invest more in long-term machines for the long term? Which one? Hands up for A. Hands up for B. Hands up for C. Why did you say C? Anyone up the back? Yes?
Because you think the rewards for the company with the rewards for the CEO. So you think the incentives of both the company and the CEO. So you incentivize the CEOs to make absolutely first of the company.
Yes. Now, of course, if you compare this investment, no investment at all, none of these will matter, okay? But when you're comparing various investments of different time frames, if you use A or B, CEOs are always going to lean towards the machine with a shorter time frame, not the one with the longer, because they get penalised in those next 3 years with those depreciation under regime A and B. But under regime C, whereas little depreciation the first year and then more and more and more and more and more, it actually counteracts that short-term myopic incentive that CEOs have to choose machines that have a shorter lifespan and probably provide less value to the organisation, but just provide most value for their term in office. Okay? Now, C is not a respected depreciation approach according to taxation, according to accounting rules. But it's one way of thinking about how you can improve the alignment of CEO incentives and capital investment decisions made in the organisation. Okay, so yes, Emma.
Speaking of incentive and their decisions, a lot of companies, they tag CEO with shareholders. So even though they leave the company, they're still a part of the company, right?
You mean using options?
Like, sometimes a lot of CEOs are major shareholder of their own company. So
Yes.
even though they no longer are a shareholder, they're still a major, although they're not longer a CEO, they're still a major shareholder of the company. So
Yeah, that happens too. And yeah, so I guess, very good point. I guess one point that Pima mentioned was that there's other parts of the compensation package that helps to counteract that short-term myopic decision behaviour, and part of it could be options that don't vest for 10 years or longer. So there's other ways of doing that. But depreciation is another thing that I just want you to be aware of, okay? It's not just options. There's been a lot of controversy about options and how they're used and whether they're used too much and whether CEOs deserve them or not. This is something that's not controversial in terms of getting more alignment in the organisation. But it's not part of the accounting standard and it's not part of the taxation rules. Okay? I want you to be aware of that. Okay? So, learning objective 7. Identify relevant cash inflows and outflows for capital budgeting decision. So here's basically a summary of what we talked about earlier. The initial investment, the cash flow from operations, and the terminal disposal. They are the 3 different parts you need to be aware of. And that's showing it now, the same example that's in your textbook, but heavily simplified. I'm really not sure why they show it as example 4 later on in the textbook, and they should show it earlier before they actually power it up with all the time value of money calculations and things like that. But basically there's your first part. Again, repeating, there's our regular cash savings, net cash inflow, and then there's our final part. Okay, so managing the project at the end, strategic considerations. I just gave you a real live example about getting CEO alignment. And basically that's what we've covered today in cash capital budgeting. Having said that, I've shared with you some issues that overlap with your corporate financing study. We didn't spend too much time on time value of money, which is very important, valuation. Ultimately, I didn't talk about where does the 12% rate of return come from? Where does 11% rate of return come from in some of these examples? In many cases, they may come from the cost of capital that you calculate in corporate finance, adjusted for some risk factor. Okay, that's one area where they can come from. Okay, the cost of capital. Ultimately, the big strategic investment decisions companies make need to take into account the cost of capital. If they have a return that's less than the cost of capital, then theoretically, under corporate financing theory, their share price should what? Go down. Okay, but as long as they keep investing in things that have a greater return than the cost of capital, then the share price should go up. Okay? That finishes the lecture on capital budgeting. I want to know the week after next, I'm going to talk about the following. Number 1, we're going to talk about the balanced scorecard game. Okay? Key learning points. Okay? And we're going to talk about the balanced scorecard principles. All right? And ultimately, we're going to talk about measurement examples. And if I have time in the lecture, talk about a case study implementation of the balanced scorecard. The reason why you played the game before we start talking about that introduced in lecture, I did this 2 years ago, it worked really well. Last year I did it 3 years ago. 2 years ago when I did it the other way around. That means you played the game in the second half, not in the first half. I find that now you played the game and we talk about scorecard in lecture, we can actually refer back to your experience. So that's why I want, even if you haven't won the game yet,